This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first video in the course, and in this video I will talk about basic terminology. If you are already familiar with the terms that I use, you can go ahead and skip this video. All traders often use words that can be very unclear, and for definitions you can go to my website, brookstradingcourse.com, and there is a glossary there. For example, throughout the video course, I will be using abbreviations on different slides, and these are some of the common ones that you will see. Always in long, always in short, buy low, sell high, scalp, breakout, the close of a bar, double bottom, double top. When you hear me talk about a moving average, I'm talking about a 20-bar exponential moving average, or an EMA, then the high of the bar. HFT, high frequency trading. When you see me use HH, I'm talking about a higher high. Low is L. A lower low, a low that is below a prior low, is a lower low. When I say moving average, that's the same as the exponential moving average, except rarely I will talk about some simple moving averages. When I do, I'll explain it. Moving average gap bar, when there's a bar where there's a gap between the low or high of the bar and the moving average. Measured move, I talk about this in every video. Major trend reversal, MTR, I talk about that in almost every video. Open of the day, pullback, PB, I refer to that in almost every video. Sell. And then when I talk about corrections, especially after a climax or when I'm expecting a reversal, you'll often see me use the phrase TBTL, 10 bars, 2 legs, which is a common occurrence when the market is trying to correct. Trading range, TR, and when the trading range is particularly tight, I call it a tight trading range, TTR. Every market at all times is either in a trend or in a trading range. A bull trend typically begins with a bull breakout, which is a big bull trend bar, a white bar. Bear bars are black bars, and here the bar opens at this point at the bottom of the white box, and that is the close of the white box. After the breakout, which can last many bars, here it lasted a couple bars, there is a pullback, where a low of a bar goes below the low of the prior bar, and that usually results in a transition from the breakout phase of a trend, which is very strong, into a channel phase of the trend. And a channel is a weaker trend, but it's still a bull trend. We're still going up. We have highs that are above prior highs, so we have higher highs, and we have higher lows, and that is the definition of a trend. Eventually, a channel typically evolves into a trading range. So I view a bull channel as a bear flag, because most of the time you get a bear breakout and a transition into a trading range. And once the market's in a trading range, it then is in breakout mode, which means traders are anticipating a breakout. And here we have a bull trend and a trading range. The breakout can be to the upside, in which case you're getting a resumption of the prior bull trend, or it could be to the downside and you can get a reversal of the bull trend. You'll often hear traders talk about support and resistance. Support is some price below the current price where a sell-off is likely to pause or reverse. So even though you don't see anything right here that is causing the market to go up, the market believes this price is too low. So when it gets down here, the market goes up. Here, we're a little bit lower, but the same general area. There's support down here. Every sell-off is being bought. And resistance is the opposite. It's a price above the current price, and a rally to that level is likely to stall or reverse. On the chart, you don't see a line drawn across a resistance level, but you notice the price action. The market goes up and it turns down. It goes up to that same general price area, turns down. It goes a little bit higher and twice tries to go higher, and it turns down. Traders see this price level as resistance, and they expect that if the market gets back up there again, it'll do what it did the prior times. Not always, but most of the time. A breakout is simply a move beyond support or resistance. A bear breakout is a move below support. Here we have a bull channel, higher lows, higher highs, and then we have a break below the line. This is a big bear trend bar, and it is a breakout. It's a move below support. There's other support down here, and the market broke through support here. Here it did not. It kept holding support. Eventually it broke out, and now it's testing the next lower support level, which is a prior low, and we don't know yet if it will continue down and break below that support, or bounce at that support. When the market was at this price level earlier, it rallied. Maybe it will do that again now that it's at that same price level. And it did. The support held, and a strong bear breakout led to a bounce instead of a bear trend. Every bear trend bar is a breakout. Every bull trend bar is a breakout. It's a bull breakout. We're reversing up. You can also say that we're breaking out of a very steep 2-bar bear trend. And we're stalling here, a smaller bar with a tail on top, at a price level where the market stalled repeatedly earlier. So we're stalling at resistance. We don't know yet if the market will reverse down from resistance or if it will break out. In this particular case, we broke far above the resistance level, and we had follow-through buying. So this is a successful bull breakout after a failed bear breakout. This type of chart is a candle chart. I sometimes refer to each candle as a bar instead of a candle. And you'll see on a lot of the bars, there's a black line on top. Sometimes there's a black line on the bottom. And white bars can have black lines on the bottom or on top. Black bars can have black lines on the bottom or on top. They can have them on top and bottom. Here's a black bar with a line on top and bottom, a white bar with a line on top or bottom. And I usually refer to those black lines as tails. Other people refer to them as wicks or shadows. It doesn't matter. I just like the word tail. A bar where there is either a big white box or a big black box is a trend bar. It occurs more commonly in trends. And I call it a trend bar because it's a 1-bar trend. So the market is trending up for this 1 bar. Open near its low, close near its high. In general, the strongest trend bars have relatively small tails. Sometimes they have big tails like that, but it's still a bull trend bar. It's mostly a bull trend bar. And if the tails are more prominent relative to the size of the bodies, I tend to say that's not a trend bar. It's more of a trading range bar. And I refer to trading range bars as dojis. Trading range bars in general have smaller bodies and more prominent tails. I view them as a 1-bar trading range. And on some smaller time frame chart, they are 1-bar trading ranges. A bull trend bar is a 1-bar bull trend, and on a smaller time frame chart, it's a pretty strong bull trend. And a trading range bar, or a doji, is a trading range on a smaller time frame chart. I make decisions on what I'm going to do with my trading based upon technical analysis. A lot of institutions prefer fundamental analysis. Technical analysis, I'm looking at charts that show prices, and the price action is how the price moves. How is the price acting? How is it going up, going down, going sideways? How much momentum? How strong are the moves up and down? Fundamental analysis, it's mostly used by institutions, and they are looking at economic information, and they mostly ignore charts, but not entirely. A lot of fundamental traders will say, the fundamental information supports higher prices, and anytime the market sells off, if it pulls back to some support level, like a moving average or a prior low, they'll look to buy more. In their mind, they're making the decision based upon fundamental information, betting that the bear reversal will fail. So a lot of fundamental traders also look at charts. Sometimes you'll hear the expression an ABC pullback. For example, let's say an ABC pullback in a bull trend. It's 2 legs sideways to down. It doesn't always have to be down. It can simply be sideways. And in a bull trend, I refer to those as a high 2 buy setup or a high 2 bull flag. And it's an opportunity for traders to buy, to get long. So for example, we have a little bull trend. The bull trend started here. We have a new bull leg here. We pulled back. We tried to resume up. It failed. Maybe a second attempt will be successful. This is a high 1 buy setup. Did not work. And this bar is a high 2 buy setup. And it did work. Buying above its high led to a profitable trade. Some traders would also call that an ABC pullback. So you have a bull trend and then A, B, C. A 3-legged correction, 2 legs down, 1 leg up. A leg down, B leg up, C leg down, and then bull trend resumption. And traders would buy using a stop order above the high of the bar. Here's another example. Bull breakout, a pullback. Did not lead to much of a trend. To me, this is a high 1 bull flag. I would refer to this as a high 2 bull flag. If this breakout were bigger, I would restart the count. For example, here we have a pretty big bull breakout. This correction has to do with this bar, not with this prior trend. So I'm starting the process over again. New breakout, new pullback. This breakout is not big enough for me to start the process over again. You could call it a high one. You could say this is a breakout and a pullback, or you could say, well, maybe the market corrected down and maybe this is still part of the correction and this is part of the correction. This is an A, B, C, where A went above the top of the bull breakout, but it's still part of the corrective process. And that's why I say it can be sideways to down, not necessarily down. This one was a little bit down, mostly sideways, but this one clearly is sideways. Here's another bull breakout. I'm looking for pullbacks. Okay, this is an inside bar, but it has a bare body. On a smaller time frame, that's a small pullback. On this chart, it's technically not a pullback because the low of this bar did not go below the low of that bar, but it's an inside bar. It's a pause. For me, that's a high one bull flag, and bulls will buy just above its high, looking for resumption up. In general, they'll put a stop down here because sometimes the market will go sideways and then slightly lower, but the trade is still valid. For me, this is a bull trend and a pullback, a high one buy setup. Is this enough of a breakout for me to restart the count and call this another high one? You can. I would say that it's not big enough, and I would say this is all part of the same correction. To me, this would be a high one, a first attempt up, did not get very far, and this would be a high two buy setup, and traders would buy above the high of that bar or above the high of this bar. Anytime the market forms a double bottom, bull flag, it's a high two buy setup. In a bear trend, traders are looking for the exact opposite. Here's a bear trend, and anytime there is a pullback or a pause, traders look at it as an opportunity to go short. The high of this bar did not go above the high of this bar, so it's technically not a pullback on this time frame, but it probably is a pullback on a smaller time frame. In any case, it's a pause, and traders will place a stop order to go short just below the low of this bar, betting that if it does go below that bar, the trend will resume down. Here, it simply went sideways, and here's a second attempt to go down. For me, this is a low one short, and then we have a double top bear flag. That's a low two short. So you either sell there or you sell below this bar here. Low one bear flag, low two bear flag. Same thing here. As the market's going up, after each bar, traders place a stop order to go short just below the low of the bar. They place a stop order when this bar closes to sell right below the low of the bar. They get filled here. It's still going up. It's still correcting, but it's still most likely a minor reversal and a bear flag. Traders who did not sell here, they might instead place an order to sell below this bar, does not get filled. They then place an order to sell below this bar, it does get filled. So a second entry short in a rally in a bear trend, it's a low two short, a low two bear flag, an ABC bear flag, ABC. There are always other ways to label things. Some traders instead will look at this as a larger low one, a sideways move low one, and then this is part of that correcting process, and then a low two where the second leg also subdivided. They'll look at this as sideways to a low one and then up to a low two. So they'll view this as a larger low two bear flag or a larger double top bear flag, first top, second top. It doesn't matter what you call it. You're looking for ways to enter the trend. And when you see these bear flags, look to sell. This is a fairly tight bear channel. The first reversal is probably minor. A minor reversal is going to be usually a bear leg in a trading range or a bear flag. We got a bear trend. We're trying to reverse, probably a minor reversal. I call it a pullback. Whenever I see a reversal attempt and I think it will not get very far and the trend will resume, I call it a pullback. That last slide, I showed a minor reversal. And look at this reversal, bear trend, and then a very strong bull breakout, follow through bar, another follow through bar. So at this point, we're in a bull trend. Here, this is a major reversal, not just a bear flag. Here, minor reversal, bear flag. Here, minor reversal, bear flag, minor reversal, bear flag. But look at the size of this breakout, far above the bear channel. This is a major trend reversal, which means the bear trend is becoming a bull trend. Now, look at this. We have a bull trend here, and then a bear breakout to a broader bull channel. But you can look at this and say, bull trend, pretty strong bear breakout. If we go above that high or test that high, maybe we'll get a trend reversal into a bear trend. And that's what we have. We have a bull trend and then a bear trend. If a bull trend goes to a bear trend, it's a major reversal. If a bull trend just goes sideways and the bull trend resumes, it's a minor reversal. Even this is a minor reversal because the bull trend resumed. So minor reversal, the trend resumes, and instead of reversing. Sometimes you'll see a bar like this. Its low is below the low of the prior bar. Its high is above the high of the prior bar. That is an outside bar. It does not have to be below. I call it an outside bar if the high is exactly at the high of the prior bar and the low goes below the low of the prior bar. For example, over here, this bar did not go above that high. The two highs are at the same price, yet its low went below. I would still call that an outside down bar, an outside bar. And an inside bar is a bar where its high and low are within the range of the prior bar. This bar, the low is above that low, the high is below that high, so this black bar is an inside bar. And look at the next bar. This white bull body, it's inside of the black bar. Its high is below that high, and its low is above that low. Same here, another inside bar. This bar is inside that bar. This bar is inside that bar. A small inside bar here. Here's an inside bar. The high is the same as that high, but the low is above that low. So I would still refer to that as an inside bar. That's why I say for an outside bar, the high is at or above the high of the prior bar, and the low is at or below the low of the prior bar. And an inside bar, the high is at or below the high of the prior bar, and the low is at or above the low of the prior bar. An outside bar here, outside bar here. And this is actually an outside bar as well. Its low was below the low of that bar. Its high was above the high of this bar. Here's the Australian dollar versus the US dollar, a 5-minute chart, Forex chart. I distinguish trades into swing trades and scalps. A scalp means that I'm trying to take a quick profit. I usually exit within 5 bars, and sometimes just 1 bar. A swing trade means I'm planning to hold onto my position as long as the trend is going in my direction. Let's look at this chart and let's talk about buying here. If I buy above the high of this bar, I get filled right here, just above that high. And let's say I get out 4 or 5 bars later below this bear bar, right where this red box is, right below the low of that bar. To me, that's a scalp. I did not allow any pullbacks. I get out within 1, 2, 3, 4, 5 bars, and it did not matter to me that the trend continued. If I buy here and get out a few bars later and did not allow pullbacks, that's a scalp. On the other hand, what happens if I exit up here or up here? If I'm exiting up here at the end of the session, to me that's a swing trade. So I buy here, I don't worry about the pullback here or here or here or here or here. None of these look like major reversals. I'm willing to continue to hold despite all of the pullbacks, and then I look to exit at the end of the session. If you're holding through pullbacks and for a lot of bars, that is a swing trade. That last chart was a 5-minute chart, and here is a daily chart. There are other terms to use when talking about scalping and swing trading on higher time frame charts, daily or weekly charts. So for example, let's say a bull trader bought here, and he got out here, he's a scalper. You might call him a fast money trader or simply a trader. And if you get out here, and this was a monthly chart, people would call him an investor. If it was a weekly chart, they might call him an investor. To me, I would call him a swing trader, even on this chart. But in general, if you're taking quick profits on a daily chart, traders will call you a trader or a fast money trader or a scalper. But usually they use the term trader. And if a person's holding for a long time, 20, 30, 40 bars, you start to get into the realm of being an investor, especially if it's a weekly or monthly chart. Some swing traders will hold far beyond a typical swing, which might be 10, 20, or 30 bars. They may hold indefinitely, sometimes for years or months, and that would be an investor. People would use the term investor instead of swing trader for that kind of a person. If you look at a chart, you see the market going up and down, up and down, up and down, and the smallest move up or down on a chart is a tick. So if it goes up 1 move, it's called a tick. If it goes up 3 or 4, it's called 3 or 4 ticks. If you're looking at a Forex chart, people tend to use the term pip instead of a tick, but it's the same thing. And nowadays, pips are also subdivided into tenths or even hundredths, but I just refer to pips and I don't worry about the tiny, small divisions. A point is a group of ticks or pips. So for example, 1 point on the E-mini chart is 4 ticks. A corresponding move on the SPDR, SPY ETF chart is 10 ticks. You'll sometimes hear traders talk about the lot size. I traded 5 lots, which means you traded 5 contracts or 5 shares or 5 units or 5 something. And a handle is a big round number. So if the spider is trading at 202.50, you would say it has a 202 handle on it. When I talk about moving averages, I'm usually talking about a 20-bar exponential moving average. Whether it's a 5-minute chart or a month chart, it doesn't matter. If you hear me say moving average and I don't qualify it, I'm talking about a 20-bar exponential moving average. Some people refer to it as an EMA, exponential moving average. I simply call it a moving average. This moving average is a 20-bar exponential moving average. Computers, you cannot get around the reality that they control all major markets. Most trading nowadays is automated. That means the orders are placed by computers, and software programs, which are called algorithms, are making decisions about when to buy, when to sell, when to add on to positions, when to slightly reduce positions. Here's an example of a flow chart of an algorithm. You'll sometimes hear me talk about an institution: Bank of America, CalPERS, the pension fund for state employees in California, Fidelity Investments, those are all institutions, Goldman Sachs. An institution could be a bank, it could be a hedge fund, a high-frequency trading firm, pension fund like CalPERS, mutual funds like Fidelity. Any large entity is an institution, and that includes large individual traders. So, for example, the smallest position size in the E-mini is 1 contract. If a trader is trading 100 contracts or 200 contracts or more, I would consider them to be as significant as an institution, even if they're trading for their own account. You'll often hear me talk about setups, and it's a chart pattern. It's something on the chart, and it makes me believe that there will be a profitable trade. Sometimes the setup is 1 bar, sometimes it's 3 or 4 bars, sometimes it's 20 or 30 bars. So, for example, we have a bull trend, and it's pulling back for a few bars, and as it's pulling back, traders are placing buy stops 1 tick above the high of the prior bar. Did not get filled. A new bar closes, they place a buy stop 1 tick or 1 pip above the high of that bar. And in this case, the trader did get filled. This is the bar when they enter their trade, so it's the entry bar, and this is the bar that signaled the entry. When they saw this bar, they thought, if it goes above the high of this bar, I want to get long. This is the signal bar, and traders get in on the entry bar. The signal bar is the reason to take the trade. It's the signal to look to enter. So here's the signal bar. We're with the trend. We're trading in the direction of the trend. Buying above this bar is buying with trend. Counter trend means doing the opposite. For example, we have a bull trend, and if I'm selling below that bar right here, it's a counter trend trade. So I'm trading in the direction opposite to the trend. Context, you'll often hear me talk about context. Is it a buy setup or a sell setup? I'm always interested in the context. And context means all the bars to the left. If I see this bar, I want to know what took place before it. Do I want to buy here? Maybe it's better to sell here. I want to know what the bars to the left look like. And those bars to the left provide the context. So, for example, if there's a strong bear trend, do I really want to be buying here? No, it's a bull reversal bar. It's a buy signal, but it's a buy signal that I would not take. If anything, I'm looking to sell. When there's a very tight bear channel like this, I don't care if there's a good bull reversal bar and a good follow-through bar. It's more likely the reversal will fail, and this bull reversal will end up as a bear flag. This is a low 1 sell signal bar. Traders will sell just below its low, expecting the reversal to fail, become a bear flag, and for the bear trend to resume. I often talk about always in. That is the direction of the current trade. For example, here I would say the market's always in long. So if I had to be in the market this instant, would I rather be long or short? If I had to be always in the market at this point, I would be long because odds are the market's going higher. In a bear trend, the market's always in short. At this moment, do I want to be long or short? If I had to be in the market this instant, if I had to be always in the market and it's right at this instant, I want to be short. The market's always in short here, and somewhere in here, it became always in long. Traders thought it was better to be long, easier to make money being long than short. I pay attention to context. The context here is that we're in a bear trend. We're getting lower highs and lower lows. We're starting to get a lot of two-sided trading. Tails below bars, some bull bars, smaller bars, sideways bars. It's still always in short, but it looks like it's evolving into a trading range, which means that it may soon reverse into always in long. 3 big bear bars, a bear channel with about 8 or 10 bars, but tail on the bottom of the bar. That's weakening, a weakening trend. Another big bear breakout, but a big tail below, and the close of this bar, the bottom of that black box, is above the breakout point. There are problems with this bear trend. Another breakout, a close just around the breakout point instead of far below. Bulls are buying prior lows and they're making money. And that usually means that a bear channel is in the process of evolving into a trading range. And once it's in a trading range, traders will start to look for trend reversals. So we have a fairly tight bear channel, and then we have a bull trend bar breaking above the high of the channel, breaking above the top of the channel. Trend lines are rarely perfect. You can see I'm using this high and then this series of highs. The market looks like it's turning down every time it hits an imaginary line at that point. I would extend the line from here all the way here. I could draw it from this high across that high, or I could simply use a small trend line from here to here. In any case, we're getting a bull breakout of a bear channel, and that means traders will start looking for possible trend reversals. So we have a low here, we reversed up. We have a lower low, we reversed up. And here, the bears are trying to resume back down, but this is forming a higher low. This setup, this buy setup here, is called a higher low major trend reversal. Higher low with the potential of reversing into a major trend. It's also a head and shoulders bottom. This would be the left shoulder, this is the head, and this would be the right shoulder. So it's a reversal setup. Not a high probability buy at this point, but once you start to get 3 or 4 bars with big bull bodies closing on their highs, the bars getting bigger, at some point, the market becomes always in long for everybody, which means that traders can buy for any reason, expecting that the market will be higher as more bars become visible. Another breakout, we have a small breakout here, and now we have 3 bull bars, and traders might buy this bar as it moves above that high, the neckline of the head and shoulders bottom. They may simply buy the close, arguing that it's the third bull close, very little overlap between the bars, and the bodies are getting bigger, and it's following a higher low major trend reversal. Over here, the tails are starting to become prominent, the bodies are getting small. Each doji is a 1-bar trading range, and here it's forming a pullback. A pullback means that when I refer to an attempt at a reversal as a pullback instead of a trading range, that means I believe the trend will resume instead of reverse. Each one of these bars is a 1-bar trading range, a doji bar, and together they form a slightly bigger trading range. Somewhere in here, traders concluded that the market became always in long. It was always in short all the way down here. This is Al Brooks, and thank you for watching this video in the Brooks Trading course. This video was on terminology. This is Al Brooks, and thank you for watching the Brooks Trading course. In this video, I'm going to be talking about chart basics and price action. First, I'm going to be talking about charts and why use charts. What's the purpose of charts? What types of charts are there? Next, I'll talk about markets and how they work. Not just the stock market, but all markets. There are now 2 versions of the Brooks Trading course. There's the Brooks Trading course, and then there is a Forex version. And each of the 2 versions is divided into 2 parts. The first part is the same for both courses, and it's on price action fundamentals. It's approximately half of the course, and this shows one PowerPoint video, and this is another PowerPoint video. Both courses have both have all the same videos. In the price action fundamentals part of the course, I also call it the base course. I cover price action theory, and I use mostly generic charts, although I have some E-mini and some Forex charts. These videos are for trading any market and any time frame. There's also a second part of each course. So for example, in the how to trade price action for the Brooks Trading course, I have a lot of charts on mostly E-mini, but some commodities, some ETFs, some Forex charts, and some stock charts. It's designed for traders who trade multiple markets. But for the Brooks Forex Trading course, it's for Forex only traders, and I focus exclusively on Forex trading, and maybe 99% of the chart examples are Forex examples. The concepts are similar to those in the Brooks Trading course, but the difference here is that all the narration has to do with Forex markets, and the vast majority of the charts are Forex charts. Why use charts? What's the purpose of charts? A chart shows current trades and recent trades. So here are the current trades, and these are the recent trades. Traders want to see those trades because they can then formulate an opinion as to what the market will do in the future. That lets them know, should they buy, should they sell. Day traders in general prefer candlestick charts like this. Overnight traders, institutional traders, they usually prefer line charts, which is just a line like this. You can see the overall shape of this is similar to the candlestick chart. So for example, if this is a 60-minute candlestick chart and each bar is 60 minutes, another bar 60 minutes, 60 minutes, and this is a 60-minute line chart, this chart is constructed by using only the closes, the close of this hour, the close of that hour, the close of this hour, plots them as dots, and then it connects the dots with a line. Here, the dots are so small you don't see them. All you see is the line. This low point right here represents this low close right there. This high close right here is represented by that high point right there. Again, this only shows closes. It doesn't show this high price or this high price. There is no best chart. There's simply different ways to represent trades. All charts are good. All show the same thing. Extreme forms of charts are useless. They do not help you make money. You should choose a chart that's consistent with your personality and your goals as a trader. A chart is on a computer screen. A computer screen has two dimensions. It's wide and it's high, and therefore it can show two variables. Traders usually put price on the vertical axis and time on the horizontal axis. Some types of charts have things on the horizontal axis other than time, but most traders use time on the horizontal axis and price on the vertical axis. There are these volume charts that try to incorporate a third variable, volume, and they do so by changing the width of the candlestick. So a wide candlestick has more volume than a narrow candlestick. Most traders do not use these bars. In fact, I don't know anyone who trades successfully using these bars. What's nice about candlestick charts is you can quickly see who owns the bar. I could create bars using any colors. Typically, for a bull trend bar, a bar that opens on its low and closes on its high, I use white. Other people use green, but when I trade, I'm using white. This means that the bulls controlled the bar. The bar opened near its low and closed near its high. A bear bar, a black bar, is a bear bar. That means it opened at the top of the black rectangle, closed at the bottom of the black rectangle, and the bears own the bar. This does not tell me what the bar did in between the open and the close. It may have gone to the bottom, may have gone up top and bottom 5 different times. But in my mind, if I see a black bar, I know it opened here, I know it closed there, I assume bears won. The bears won the bar. If I see a white bar, I know it opened at the bottom of a white rectangle. All white bars open at the bottom. All black bars open at the top. If I see a white bar, I assume the bulls won. The bulls own that bar. Sometimes you get bars like this that have very small bodies, prominent tail below and above, closing somewhere around the open. That is a balanced bar. The bulls and bears were about equally strong, and I view it as a one-bar trading range. There was a lot of two-sided trading, buying and selling. You can call it a trading range bar. I call it a doji bar. Some people use the term doji to refer to a perfect doji where the open and close are exactly at the same price. I think that's useless because it's very rare. And why give a term to something that virtually never happens? For me, I see bars as either trend bars, here's a bull trend, here's a bear trend, or trading range bars, a bar that's not going anywhere. In my mind, every bar is either a trend bar, a bull trend bar, a bear trend bar, or a trading range bar, and I call it a doji bar. So bull bars, every white bar, the bottom of the rectangle is when the bar opened, the top is when it closed. Every black bar, the open is at the top and the close is at the bottom. Bear trend bar, opened here, closed there. And then trading range bars, doji bars. You can see on the chart, a lot of these bars I would call doji bars, like this and that and this and these. Here's the only perfect doji bar on the chart. Do you think this bar has any special meaning compared to that bar, or this bar, or that bar, or this bar? No, it does not. So worrying about whether or not a doji bar is absolutely perfect, or if it's slightly less than perfect, is foolish. It doesn't matter. This bar is just the same as this bar, and the same as this bar, and the same as this bar. They're small trading range bars. The bulls and bears both were in control during part of the bar, and that's all I care about. the bar does not represent a trending market. It represents a neutral market. So any small bar where the body is maybe half the size of the bar or less, I call it a doji bar. Because as I said, I use doji to refer to a trading range bar. And I think of all bars as either trend bars, here, a bear trend bar, bull trend bars, or trading range bars, here. So small bars, doji bars, bars with prominent tails, are doji bars. Doji bars can be very big. If the body is small, I still call it a doji bar. Now, you have some bars that could be doji bars, they could be trend bars. For example, here's a small bar. The body is about half the size of the entire bar's height. I would call that a small bear trend bar. If the body is half the size of the bar or more, I tend to call it a trend bar. If it's less than half the size of the bar, especially if the bar is not very big, I tend to think of it more as a doji bar, a trading range bar. Look at this green box. That is the high of the bar. That's the highest trade that took place during this 5 minutes. And I call that line above the rectangle a tail. Here's another tail up here. Here's a tail below a bar. And it's simply the highest price or the lowest price that took place during the bar. Some bars don't have any tails. For example, here's a bull bar. There's no tail on the bottom. That means it opened on exactly the low of the bar, and the market never traded below the open of the bar. The open of the bar, in this case a bull bar, is the very first trade that took place. If this is a 5-minute chart, this is the first trade that took place as soon as that bar closed. And the close of the bar, the top of the white rectangle, is the final trade. And as soon as that trade takes place, another candle begins. For bear bars, it's the opposite. Remember, every bear bar, every black bar, opens at the top of the black rectangle, in contrast to a bull bar. Every bull bar opens at the bottom of the white rectangle. Here, there's only a very tiny tail on top of the bar. That means it opened and then traded a little bit above the open and then closed on the low. If there's a tail below, that means it traded down and traded back up. In this case, because it has a black body, that means the open was here and the close was a little bit below. So the bottom of every black rectangle is the close of the bar. The rectangle is called the body. A black body is a bear body. A white body is a bull trend bar. I mentioned that time charts can be any interval. In this particular example, this could be a 5-minute chart. It could be a 1-minute chart. Each bar could be 1 minute long. It could be a 15-second chart. It could be a monthly chart where each bar is 1 month. And here's the next month, and then the next month, and then the next month. So that is a time chart, and you can use any interval for time. Volume charts are also popular, and there are two different types. One is the number of contracts or shares traded, and the other is a tick chart. So for example, here, each bar is a 10,000 contract bar. Let's say 9,999 contracts were traded, and the next trade is 1,000 contracts. Then this bar will not have exactly 10,000 contracts. It'll have 9,999 plus 1,000 more, so it'll have 10,999. Even though it's called a 10,000 contract volume chart, the bars usually do not have the same number of contracts. As soon as a bar has at least 10,000 contracts, the bar closes and another bar begins. Here is a tick chart. For example, 5,000 ticks, where each tick is a trade. So if a trade takes place, that's 1 tick. If the trade has 200 shares in it or 200 contracts in it, it's still 1 trade. If it has 1 contract in it, it's 1 trade. And as soon as there are 5,000 trades, the bar ends and another bar begins. Here are some examples of different types of bar charts. They're not really bar charts, but I call them bar charts. A dot on close chart. If this was a 5-minute chart, this is the close of this 5-minute period. And then during the next 5 minutes, the market might be doing all kinds of things, up and down and up and down. The chart doesn't care. It only plots the final trade of that 5 minutes. Same thing for the next 5 minutes. It does not care if the market went up and down 10 times. All it cares about is the final trade of the 5-minute period, and it creates another dot. A line chart, you can see it's the same shape. The line chart is the same shape as the dot chart. All it is a dot chart where the dots are connected with a line. And you make sure that the size of the dots when you're formatting the chart are no bigger than the line. So you do not see the dots, you only see the line connecting the dots. Here's a traditional bar chart. Every bar is 5 minutes. At the end of 5 minutes, another bar begins. It shows all the trades that took place. It shows the lowest trade that took place during the 5 minutes, the highest trade that took place during the 5 minutes. The left dash on the side of the bar is the first trade, and on the right side of the bar, that dash is the final trade. So the open, it shows the open of the bar, the lowest trade during the 5 minutes, the highest trade, and then the close. And a candlestick chart is a version of that, except that if a bar opens low and closes high, the candlestick chart gives it a white body. If a bar opens high and closes low, the candlestick chart gives it a black body. So it's just quicker to see how many bear bars there are and how many bull bars there are. Here are candlestick charts and some other less popular charts. Some traders like to use rain charts, Kagi charts, case charts. It doesn't matter. They all represent the same thing. And you can see the general shape is similar on all of the charts. Here's an example of doji candles right there. Closed around the open. Some are relatively big, some are relatively small, and every doji bar is a 1-bar trading range. And they can be any size. Is this a doji bar? It has prominent tails, but it has a pretty big body. If the body is more than half the size of the bar, I usually call it a trend bar. So I would call that a bull trend bar with prominent tails. Here's a bar with a bare body. Is it a bear trend bar? No, I would call it a doji bar, a bear doji bar, because it has a very small body relative to the size of the bar. Here are some bear dojis. This one, the body is about half the size of the bar. So I would call it a doji, plus it's a small bar. And here's a bull doji, a bull body and prominent tails, the body less than half the size of the bar. The prominent tails mean that it's a weaker trend bar, but it's still a trend bar. You'll often hear people talk about the market, or the stock market, or the futures market, or the forex market. There are many types of markets. In every interaction in life, there's always somebody who wants to give or sell something, and there's always somebody else who wants to buy something, and they trade between one another. For example, the real estate industry creates the housing market. It's a way to buy and sell houses. If there's no market and you wanted to sell your house, you'd have to go door to door or put an ad in the newspaper, hoping that you'd find someone who wants to buy your house. More likely, you would not find many buyers. If there are not many buyers, well, guess what? They know you need to sell, and there's not much competition for them buying. They can offer a very low price. Also, for example, if you wanted to buy a house and there was no market, you could go door to door asking someone, can I buy your house? Can I buy your house? Can I buy your house? Chances are, since there's no competition, the seller does not feel like he's competing against a bunch of other sellers. He is only going to be selling for a very high price. He's an uninterested seller. And for you to get him to sell, you're going to have to offer him a very high price. The advantage of a housing market is it brings lots of willing buyers and sellers together. And therefore, you have buyers and sellers competing with one another. And it tends to keep the price fair. So if there are a lot of buyers, they are not going to pay too much. They're not going to pay too little. If there are a lot of sellers, you have a lot of people deciding what fair value is, and the housing price is more accurate, more realistic. I said the industry creates the market, just like there's a stock market industry that creates different markets, different exchanges, the New York Stock Exchange, the NASDAQ Stock Exchange. And the industry gets paid a commission. So the real estate brokers get together and they decide on a commission. So, for example, in California, a 6% commission is common. If you're buying a house, you have a buying broker. If you're selling a house, you get a selling broker, and they split the 6%. If you sell a house for $100,000, you do not get $100,000. 6% is the commission. You get $94,000. And the two brokers, the buying broker and the selling broker, split that 6%, that $6,000. It's very helpful if you're buying or selling a house to know what comparable houses have sold for recently. In trading stocks, you really want to know what the last trade was, right? You want to look at recent comparable sales to get an idea of what the fair price is. So if you're trying to buy a house, you want to make sure that you're not paying too much. And one way to do that is to look at recent sales. If there are a lot of people in the market, a lot of buyers, a lot of sellers, you typically do not have to wait long to sell your house or to buy another house because you trust that the prices are all just about right. So that's a tight spread between what the sellers want for selling the house and what the buyers want for buying the house. The spread, the difference tends to be pretty tight, and it tends to accurately reflect the fair value of the house. So if you get a lot of buyers together and a lot of sellers together, traders tend to trust that the price is accurate and fair at that moment. There may be the wrong price a month or two from now, but at that moment, when the buyer wants to buy and the seller wants to sell, if there are a lot of buyers and sellers, chances are the price is going to be very close to what a fair value is. So if you're selling a house and you get somebody who says, I want to buy your house, and they offer too little, at least in your mind, they offer too little, wait, because you can trust that if you priced your house fairly, you'll be offered more by somebody else. Also, if you're a buyer and you really want to buy value and you tend to offer 10% less than the fair market value, you're probably going to have a hard time finding a house to buy, because there are other buyers who want to buy and they're more willing to pay fair value instead of a low price. So if you want to buy a house, you're going to have to pay more. Financial markets, same thing. They bring buyers and sellers together. The NASDAQ has Apple and Google. A lot of people at any instant want to buy Apple. They want to sell Apple. There are a lot of people who want to buy Google and sell Google. The New York Stock Exchange, JP Morgan. A lot of people want to buy JP Morgan. At the same time, a lot of other people want to sell it. And the stock market brings the buyers and sellers together, and they get almost instantaneous transaction. You do not have to wait to complete a trade at a fair price. You know that when you trade, you're buying the exact appropriate price at that instant, and there's a very tight spread between the bid and the ask. So for example, if I wanted to buy Google, the ask is $548.15. I'm going to pay $548.15. If I want to sell Google, it might be 08, and that's not a very big spread. Here in JP Morgan, the spread might be just a penny. It's a much cheaper stock, a 1 penny spread. And the industry gets paid a commission. You pay the industry a commission for creating the opportunity to have that transaction. The industry, the New York Stock Exchange, for example, here, they have a building, they have the electronic infrastructure that allows buyers and sellers to come together, and they need to get paid to maintain that, and that is the commission that they charge both the buyer and the seller. In the Forex market, the commission is the spread. So here it'd be a 1 pip profit. Markets are constantly trying to find a price that both buyers and sellers think is fair. They never know exactly. They know exactly at one instant, but the price is always changing. There's always new information coming in. More buyers, less buyers, more sellers, fewer sellers. And then there's international information coming in, business information coming in. Every conceivable piece of information that comes into the market moves the price up and down. And the markets constantly move in search of a fair price, because that is the price that results in maximum trading. And that is the purpose of all markets, to maximize the amount of trading. If the price is way too low, guess what? No sellers, so there'll be no trades. If the price is way too high, guess what? Nobody's going to buy. No trades will take place. So the market is always in search of a price that will maximize the number of transactions, the fair price. It's constantly changing with every piece of information. It's difficult to know exactly what the fair price is. The market's constantly probing up. If it runs out of buyers and sellers come in very aggressively, the price is too high, it goes down. If all of a sudden it gets too cheap, a lot of buyers come in and the sellers stop selling at this price, they're only willing to sell higher, price goes up. The market's always probing to find out what too high is, what too expensive is, and what too cheap is. So for example, here the market thought this was a fair price. And then the fundamentals change. Some piece of information that comes out, in this particular case, the market suddenly decided that the price was way too high, and we got a big bear breakout below the trading range. The market is in search of a new fair price where it will oscillate around and create a new trading range. Because fundamentals change constantly, and there are countless fundamentals, you don't even know most of them. Different institutions provide news, buyers and sellers come and go, they change reasons for buying and selling. It's changing constantly. The fair price changes constantly. However, it's usually in a fairly tight range. Most of the time, markets are mostly sideways. Some of the time, they quickly move because everyone perceives that the price is wrong. Up here, traders decided the price is too high. Buyers and sellers both decided that it's too high, so it had to move down quickly to find a price where both buyers and sellers thought the price was fair. For here, the market was staying in this general range because buyers and sellers thought it was fair. If it went up a little too high, no more buyers, sellers got aggressive, the market went down. If it goes down too low, sellers think it's too low to sell, they stop selling. Buyers think it's a great value, they buy, and it tends to go up. Markets constantly need reassurance that the price is right, that the price range is approximately right. It probes up, it probes down. It's constantly trying to break out. Tries to break out, reverses down. Tries to break out, reverses down. Tries to break out, reverses down. Tries up, reverses down. It probes down. Maybe the fair price is down here. So let's try to get there. Cannot get there. Sellers stop. Buyers get aggressive. Tries to go down, fails. Tries to go down, fails. Tries to go down, fails. Tries to go down, and fails. So it's constantly trying to break out. It's constantly trying to see if maybe the price needs to go lower. Maybe it needs to go higher. And it spends most of the time going sideways, with 80% of breakout attempts up and down failing. That's how it determines where the appropriate range is. And the markets really want the range to be extremely tight. They want to bring buyers and sellers together with very little spread, and they're always in search of the perfectly fair price. The markets always want to be in trading ranges, and they prefer to be in very tight trading ranges. I said the purpose of a market is to facilitate trading. And one of the consequences of market moves is to create the maximum number of trades and traders. The market is always moving in a way to force traders to behave, to take trades. It's trying to get traders to trade even when they don't want to trade. So if you're long a stock, guess what? The market's sometimes going to fall very far to force you to trade, to force you to sell, or force you to buy more. As I said, when price falls too far, no one's going to sell, so there's no trading. So the market has to move higher to find sellers. If it goes too high, buyers are not going to buy. And the market has to go back down to find buyers. It's always in search of the price range where trading is going to be maximum. It wants the maximum number of traders taking trades. It wants the maximum number of trades taking place. It wants the maximum number of contracts traded. Let's say, for example, Apple is being offered at $1 billion a share. No one would buy. Since no trades would take place, the volume would be zero. The price has to come down to find buyers. In this video, I talked about the purpose of charts and the types of charts, and I also talked about how markets work. This is Al Brooks, and thank you for watching the Brooks Trading course. This video was on chart basics and on price action. This is Al Brooks. Thank you for watching the Brooks Trading course. This is another in a series of videos on chart basics and price action. In this video, I'm going to be talking about the importance of volume and news. In the last video, I talked about the purpose of markets is to facilitate trading. Markets are designed to increase the number of traders placing trades, increase the number of trades being placed, and increase the total volume of trades taking place. Now take a look at this chart. The market is going down. As it's going down, we have a slightly lower low in price, but we have a lower low in volume. What will traders assume? They will assume that if we continue down, volume will get less and less and less. Markets are designed to maximize trading volume. If the market is going down and finding fewer people willing to trade and less volume, it's going the wrong direction, because theoretically, ultimately, if it keeps going down, eventually there'll be no trading at all. And that is not what the market wants. The market tries to oscillate in an area where trading volume will be maximum. Just because volume is getting less does not mean that the market has to go up to find more volume. It sometimes can find more volume by simply going sideways, entering a trading range. So lower price and lower volume. Traders are not interested in trading at this price, so they have to find a new price. If they go lower, they're going to assume there'll be even less volume. So lower is not the answer. The market probably has to go higher to find traders willing to place trades. And you can see we go up a little bit here and volume goes up a little bit. A volume divergence often leads to a rally. So here, price is low, lower, lower, but as it goes lower, volume is getting less as the market is going down. As the market is going down, fewer traders are interested in trading. Theoretically, if it keeps going down, no one will trade. There won't be anyone willing to sell at the low price. Therefore, a lot of times, as the market is going down, volume tends to dry up, and the market has to go higher to find sellers willing to sell. Usually, if the market has a bear breakout on big volume, that low is not going to be the final low in price. Usually the market will go lower, sometimes 2 or 3 times lower, to confirm that the volume is getting less. The conclusion that traders make is that no one is willing to sell at this price. Everyone's happy to buy, but nobody's willing to sell. If you want to buy and nobody's selling, you're not going to get to buy. The market has to go higher to find a price where sellers will come back. This is an E-mini 1-minute chart, and 3 pushes down, so it's a wedge bottom. Not really classical wedge shape, but 3 pushes down. We got a sell climax, a second push, and a third push, a spike and channel bear trend. I once traded with a trader many years ago who looked for volume divergences. As the market's going down, he's looking for volume getting less. As it's going up, in a spike and channel bull trend, he'd look for volume getting less, and he would look to trade the divergences. But the problem with trading that way is that if you're a day trader, you're looking for many trades a day. However, a perfect wedge bottom with a double volume divergence, here's the first volume divergence, here's the second volume divergence, that kind of a setup only occurs once or twice a week. So you end up watching the 1-minute chart all week long to find 1 or 2 trades, and you have to hope that you're actually watching the computer at the time that they occur. Do I pay attention to this? No. There are far more important other things that give me far more trading opportunities. Take a look, here we have a bear breakout and a follow-through bar. So a bear breakout and a follow-through bar. But look at the volume. It's really not all that big. Do I look at the volume and say, oh, here's a bear breakout, but look how bad the volume is. I'm not going to take the trade. Or do I look at this and say, bear trend, double top, lower high, bear bar closing below the low of the past 15 bars, closing on its low, I'm going to sell. I don't care what the volume is. To me, this is a sell. The volume can trick me into not taking a very good trade. And volume, or any other indicator for that matter, is often an excuse that beginners use to not take a trade, even when the trade is a high probability trade. Traders often use indicators, volume, anything, to talk them out of taking what is a good trade, a trade that they should be taking. I think using volume, you're not going to make any more money. Now, here we have a bull breakout. We have a sell-off, a low 2 bear flag, 2 pushes up, 1 pullback 2, and we tried to break to the downside. Instead, we broke to the upside. All right? So you say, oh, look at that big volume. We have a bull breakout. Certainly, the market has to go up. Well, look what happened. Instead of going up, it went sideways and then down. Here we have a bear breakout with terrible volume, yet the market continued down. And here we have a bull breakout on big volume, and the market went sideways and then down. So the volume was misleading on the bear breakout, talking you out of the trade. And the volume was also misleading on the bull breakout, convincing you that you should trade, that everyone's buying the breakout. And in fact, it was a failure. So I'm just using this slide to illustrate the reality that looking at volume is not going to make you any money. In fact, if anything, you'll end up losing money because you'll use it as an excuse to do something or to not do something that you should be doing. When I look at this chart, I don't need to look at volume. I know this has the biggest volume on the chart. Why? Because it's the biggest bar on the chart, by far bigger than any other bar. And in general, when you get a big bar like that, it's going to have big volume, especially in this context. We had a bull breakout above the high of the past 30 or 40 bars, and then an even bigger bear breakout. So the odds are probably 70 or 80% that there'll be at least a small second leg down. So I don't need to look at this volume to know that this volume is much bigger than all of that volume. When I see this, I'm selling. I don't care what the volume is. I don't care what the stochastics are. I'm selling. I'm selling as the bar is forming or when the bar closes. I place my trades based upon price action, not volume action. Volume is a false god that beginners hope will protect them from a painful loss. Like any other indicator, traders are looking for something to save them, or they turn on television hoping that some very persuasive guy with a powerful title and a great demeanor will help them make money. And traders are always looking for someone who will protect them against the evil market who wants to destroy them. And that's just not real. You have to take responsibility for what you're doing, and If you see a bull breakout and then an even bigger bear breakout, it's a surprise. And whenever there's a surprise, you have trapped bulls and bears. You have bulls who are trapped in, denying the reversal, and they're holding long. They're hoping for any kind of a bounce to sell out with a smaller loss. And you also have trapped bears, bears who want to get short, and they wait for any kind of a pause bar to sell, to get at least a little bit more down. Look at this. This is the euro versus the dollar, a forex market, and there is no volume. At least for most brokers, there's no volume. Some brokers have volume, but the volume is only the volume at one particular bank or two or three particular banks, and it really does not give you a sense of what's taking place worldwide in the forex market. When traders are trading forex markets, they're not paying attention to volume. So if volume is so important for trading, how can forex markets be the most popular markets in the world when most traders who trade profitably don't see any volume? For example, look at this bar. Do I need a volume bar to tell me that a whole bunch of traders just sold here? Of course not. Just look at the bars. The biggest bar in the past 30 bars, far bigger than all the others, closing on its low, closing below the lows of all of these bars. Something important just happened, and the odds are 70% or more that you're going to get some follow-through selling. I don't need volume to tell me that the market's going down. I can just look at that bar, and I know that the market is going lower. DOM traders, depth of market. They take trades based upon the size of orders at the bid and ask. Time and sales, this is another thing traders look at. If an order is not filled and you think your broker messed up, you can look at the time and sales to argue with the broker, telling them that the trade should have taken place and that their software made a mistake. That used to be true years ago, 10, 15, 20 years ago, when everything was not electronic and there were people involved in the order execution. You'd call up, someone would answer the phone, they give the order to a runner, take it to a guy in the pit guy fills it, gives it back to the runner, and then it gives it to the guy on the phone. So there are a lot of steps and a lot of people involved, and mistakes were common. But nowadays, everything is electronic, and it's extremely rare to get mistakes. If you place an order, it's going to get filled, and if there's a mistake, it's usually a mistake that you made, hitting the wrong button or having the setup wrong. For DOM trading, depth of market, a lot of traders look at the size of the bid and ask orders. And there are different types of DOM trading. Some traders get depth of market with level 2 data, and that allows them to see hidden orders, and you get a very different picture of what's going on. Like here, look at the circled data. You can watch big orders appear and disappear, and in general, the idea is to trade in the direction of the big orders. Here's TradeStation, here's Interactive Brokers, and this is time and sales. And I'm showing this slide to make the point that time and sales, especially for a lot of brokers, certainly for TradeStation, it's useless. So look at the size of these orders, 1 lot, 2 lot, 3 lot, 4 lot, and here are the times to the second, and you can see corresponding times over here, and look at the size of the orders here, 600 contracts, 32 contracts, 200 contracts. TradeStation only shows limit orders. Some traders trade at the market, some traders enter with stops, and some traders trade with limit orders. TradeStation, time and sales only shows limit orders. So looking at it is useless because you're only getting a little piece of the information that it really exists. It does not show market orders. It misses most of the large trade due to deconstructing the orders, taking them apart and showing them in little pieces. Interactive Brokers also shows market orders. Here's a trade with 672 contracts. Here's another trade with 202 contracts, and you do not see them at all here in TradeStation time and sales. But even Interactive Brokers has problems. So TradeStation clearly has problems, but even Interactive Brokers has problems as well. Interactive Brokers does not show every trade. They only show sampled data. They're never clear to me on the phone what they mean by sampled data, so I don't know if they're showing every other trade that takes place, every third trade, or every fourth trade, but they're not showing every trade. Also, here's another problem. Every now and then you're looking at time and sales. Here's the E-mini contract. And look at this. Look at the size of this order. 330,000 contracts. And price didn't move at all. Maybe moved a fraction of a tick. So do you believe that someone actually placed an order that got filled with 330,000 contracts and the price did not move? No, of course not. It did not happen. You get data like that you see that is clearly wrong, and you don't know what to do with it. 330,000 contracts. When you translate that into dollars, let's say the S&P is trading at 2,000 and it's $50 a point, so that's $100,000 per contract, and there are 330,000 of those contracts being traded. That's bigger than the annual budget of the Philippines. So do you think that actually took place and did not move the market at all? No, so it's clearly a crazy piece of data, and you don't know what to do with it. Every now and then, stuff happens that you don't understand, and it happens much more often in the financial markets than a lot of traders would like. For example, this is the euro versus the Swiss franc forex market, and look at this. The market is trading up here at 1.2, and then it's trading down here at 1.0400. A 13% gap in the currency between this trade and that trade. So this is an example of a black swan, of an extremely low probability event, an event that a lot of people say is impossible, it cannot happen. There's no way the euro versus the Swiss franc can drop 13% overnight like that. But stuff happens. Also, I have to say that I've been trading now for about 30 years. Every now and then, something happens and the orders stop working, your data stops working, firms can go bankrupt. If your software locks up, you call, they'll say, oh, it's just a little glitch and it'll never happen again. Stuff happens. Exchanges can stop working. The order systems can be so overwhelmed. And every time it happens, you call your broker and they say it's never going to happen again. And it happens. I have to say, crazy stuff like that happens less than it did 20 and 30 years ago, but stuff happens. For example, you can get a 13% drop in the euro versus the Swiss franc when a typical big day would be 1% or 0.5%. News. Traders a lot of times pay a lot of attention to the news. I remember 20, 30 years ago, trading, everyone would pay all kinds of attention to news reports, like 7 o'clock California time. What is the federal trade deficit? For years, that was the big thing. Then for another few years, what's the PPI? What's the CPI? And traders would watch, and there'd be some big move up or down. And they'd put pundits on television right before the news comes out saying that if the number does this, the stock market will do that. And half the time, the market did the exact opposite of what the experts said it would do. And why is that? Because the market prices in the number before the number is released. So there's a 50-50 chance that the market is going to go up, 50-50 chance the market's going to go down, no matter what the news is. So it's not the news that's important. All that matters is the reaction to the news. Price is truth. One of the worst things I think you can do is right before some big news event comes out, if you watch the news, you'll listen to the experts on TV telling you what the market will do depending on if the news is good or the news is bad. Absolute total waste of time. They have no idea what the opinion is of the 200 big financial firms that rule the world, right? That control the markets. They may know about their firm, but they don't know about the other 199. Whatever they say, at best, has a 50% chance of being right. All I care about is if the market's going up, I'm buying. I don't care what the news is. I don't care what the pundits say. If the market's going up, I'm buying. That's all I care about. Institutions. All institutions have opinions about the news and about what the market should do, depending on the results of an upcoming report, FOMC meeting report, trade balance, any kind of news issue, the Brexit vote. And all of the institutions try to make their price as neutral as possible before the announcement. They're all buying and selling in such a way to feel like they're in the best possible situation to make the most money when the news comes out. The news is priced into the price before the news is announced. And you don't know if they priced in too much, you don't know if they priced in too little. So the market can go up sharply on terrible news, and it can go down sharply on great news. So knowing the news does you no good. You do not make money knowing the news. You make money knowing what the market does after the news. If the television experts knew how to make money off the news, they would not be on TV. They would be trading. And frankly, I don't know why they put them on television, because most of what they say is totally unhelpful to traders. Sometimes you'll hear, before a news report comes out, some pundit saying that if the number is X, it's bearish news, or if the number is Y, it's bullish news. And to me, that's ignorant. It's just totally naive. All that matters is how the market reacts. I don't care if the news is bullish here. I don't care if the news is bearish here. All I know is the only way I can make money is buying. I'm only interested in buying. So if the news is bearish, yet the market goes up, that simply means that more institutional dollars expected the news to be worse than it was. So as bad as you think the news was, they priced in worse news. So when the news came out as bad, but not as bad as they thought, what happens is this: the market goes up. And nobody knows in advance how many dollars are betting that it's going to go up, how many dollars are betting that it's going to go down. You only know after the market starts to move. You got a big bull bar here, closing above its midpoint, a follow-through bar with a bull body here, and then another bull bar closing on its high. Chances are the market's going higher. And I don't care about the news. All I care about is making money as a trader. Likewise, if the market goes down and the news sounds extremely bullish, that simply means that more institutional dollars expected better news, right? They were expecting the bullish news to result in a huge rally. And when the news was not quite as good as they thought it was, well, they priced in much better news than what they were expecting. And the result is the market can go down far and fast on good news. They always have to make the price appropriate for the fundamentals. And if they made a mistake on the original pricing, they have to adjust it. All that matters is price. Price is truth. If there's bad news, but good price, you buy and you don't worry about the news. Let's say a stock missed on the top line on an earnings report. So the revenue is less than what they expected. And let's say they also missed on the bottom line. Their total profit is less, but the market still rallied. Is the report bearish if the market is going up? No, to me, if the market is going up, despite the news appearing to be bearish, the stock bringing in less money and making less profit on the money that they're bringing in, to me, that's a bullish report. All I care about is this: if it's going up, the news is bullish. I don't care if the stock did not bring in the revenue that was expected. I don't care if the company made less money than expected. The market is telling me that it's a good report. I don't care if an analyst on television is telling me, oh yeah, boy, bad revenue, bad profit. I don't care. The market's telling me everything's good. Likewise, the stock can also sell off if it beats on the top and bottom lines. So let's say it makes more money than what people are expecting, and the total revenue is greater than what people were expecting. If the market goes down, I don't care. You can call it a bullish report. I would call it a bearish report. All I care about is the market's reaction to the report, not the pundit's opinion about what is bullish and what is bearish. News is useless. All that matters is price. Price is truth. So if there's bad news, but the price action is good, I'm buying. You'll sometimes hear traders talk about, is the market risk on or risk off? And what they mean is, if the market is falling sharply, traders are scared of losing money, so they want to reduce risk. So they'll say it's a risk-off market. And when they believe it's a risk-off market, they look for less volatile things to trade. They want to reduce their risk. So they may switch to trading consumer staples like Procter & Gamble, Coca-Cola, Verizon, instead of highly volatile stocks like technology stocks. On the other hand, take a look at over here. When the market is going up sharply, traders believe it's going to go up higher. They're more willing to trade riskier stocks. So if this is the overall market like the S&P and it starts to rally sharply like this, traders expect it to go higher. Traders will make more money trading more volatile stocks and taking on more risk. They'll say, oh, this is a risk-on situation. Instead of trading low-risk stocks that don't move very much like Procter & Gamble or Coca-Cola, they'll switch to stocks that tend to move more than the overall market like Facebook or Apple, or even riskier stocks than that. So when the market is falling, it's risk off. Traders are going to only trade things that have less risk. When it's going up strongly, it's risk on, and they'll trade things that have more risk. When you're in a risk on situation, it's a momentum situation. Traders don't care about anything other than price. They see the market going up, they believe it's going to go up more, so they'll just keep buying. They don't really care about earnings. All they know is that the market is going up, and so they're not concerned about risk. They're just concerned about probability. They know that if they buy, there's a high probability of making a reward, so they're going to ignore risk. They're going to ignore earnings. They're going to ignore news. All they know is that the probability is great, and they're more willing to trade much more volatile stocks. As I said, technology, biotech stocks, because they know those stocks move more than the more conservative stocks, and they want to maximize their profit. They know this is not going to last forever, so when it's occurring, they want to be in stocks that give them the best potential for profit. Whenever the market is going up sharply like this, traders believe it's going to go up higher. So you buy here because you believe it's going higher. You buy anywhere in here, a very tight channel, basically a micro channel, no pullbacks. You buy anywhere in here because you believe you'll make money, that it'll go higher and you can sell it for more money. A lot of these traders are momentum traders. They're not buying because the market is cheap. They're buying because the momentum up is strong, and they believe the momentum alone will carry the stock market higher, or the price of their stock higher. They don't care about fundamentals. All they care about is momentum. They don't care about value. They don't care about earnings. They don't care about news. All they know is if they buy money, they'll probably make money. So they're just trading on probability. Traders sometimes refer to FOMO trading, fear of missing out. It's an acronym. And this is a good example of FOMO trading. When the market is racing upward, they're afraid that they're going to miss a great opportunity. So they buy, right? The institutions are judged on their performance compared to other firms. And when you get these brief opportunities to make a lot of money quickly, everybody buys. And with everybody buying, it is self-perpetuating. The market just keeps going up. Firms cannot miss big moves like this. They don't happen all that often. In general, about 10% of the bars on any chart are in a strong breakout like this. And this is where traders make their money. So they cannot risk missing one of these opportunities. As I said, only 10% of the bars on any chart look like that. And when this starts to happen, traders buy. And with everyone buying, it's self-perpetuating and it goes up. Traders are afraid that they're going to miss a big opportunity. You can call it a risk-on market. You can also call it a FOMO market, fear of missing out market. It's a momentum market. Everybody's buying because they know the probability is it's going to go higher. Buying at any point in here will result in a profit. Momentum traders, they don't care about fundamentals. They buy even if the market's expensive because they're confident that the market will trade higher. So here you are buying at the top of 6 or 7 or 8 bars, 10 bars, 15 bars. The momentum traders, they don't care. They don't care about the fundamentals. All they know is the market's going up and they'll make money if they buy. They don't care if it's expensive. They don't care about PE ratios. All they care about is it's going up and they want to buy. They buy simply because the market's going up. And they don't care why the market's going up. They don't care what the fundamentals are. They don't care what the earnings are. They don't care what the news is. All they know is when the momentum is really strong, they want to buy. Value traders, on the other hand, pay a lot of attention to price. They only want to buy when the market is cheap. For example, a value trader will look at this and say, wow, the market's really cheap here. And they'll buy more lower because if they believe value is really good, that the market is cheap, they'll buy more lower. Carl Icahn is famous for scaling into trades in falling markets. So if a stock is falling, but he thinks it ultimately is going to go up, he'll buy, and if it falls more, he'll say, wow, that's a good value. I'm going to buy more. Value investors pay a lot of attention to fundamentals. They know what the value of the stock should be, and if it's below that value, they buy, and if it keeps going down and the fundamentals of the company are still good, it's even a better value, so they'll buy more. Value firms only want to buy when the market is very cheap. No one ever knows what the correct price is, but value investors have a really good sense of when the market is far below the correct price. They buy as the market's going down, and they buy more lower because they see it as an opportunity to buy at an even better price. In this video, I talked about volume and how traders should not pay attention to volume. I also talk about news and how you don't have to pay attention to news. All you care about is whether the market is going up or going down. You want to make money. The news doesn't tell you how to make money, but if the market is going up, you want to buy. If the market is going down, you want to sell. And it can do either on good news or on bad news. The news is irrelevant. All that matters is whether or not the market is going up or going down after the news. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is another video on chart basics and price action. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is another in the series of videos on chart basics and price action. In this video, I'm going to be talking more about what exactly price action is And then I'm going to move on to discussing the pain trade. Price action is any representation of price movement on any financial instrument, on any type of chart, on any time frame. And 50 years ago, reading tape coming off a ticker machine was a type of price action analysis. Price is changing with every tick, every trade during the day. And every price change is an example of price action. So for example, here's a tick chart where every little bar is one trade. We went up, here we went sideways, we went up, we went down, we went up. Sideways here for a few trades at the same price, and then we went up. Sideways at the same price, and then we went up. This tick chart shows every trade that takes place during the day. Everything is important. Never dismiss anything as noise or unimportant. Some things that initially look like they're not very important often lead to great trades. I think that traders who talk about noise really do not understand the markets. They're either lazy or they're simply ignorant. There is no noise. Everything that happens for a reason. Noise implies that the movements are random. Nothing is random. All the trades are being conducted by computers with algorithms, and the algorithms are logical. Just because you do not understand the logic does not mean that it's random price action. It's not. Everything is for a reason. So whenever I hear somebody talk about noise, I simply think that they just don't understand. They don't understand what's going on. Look at this chart. We have 4 consecutive bull bars closing above their midpoints. Traders start buying closes. At some point, traders call this a buy the close bull trend. They wait for the bar to close, and then they just buy. They buy the market, or they place a limit order to buy the close. If you're a buy the close bull and you bought right here and you see this, what's your feeling? Are you thinking, oh boy, we're going higher? Or do you say, gosh, that's disappointing, right? So you have disappointed bulls who bought this close. Now, if you're one of those bulls, what are you going to do? You're going to place an order to get out break even. So you buy here, you're disappointed here, you place a limit order at that price to get out break even. And what happens? If enough traders do that, then the bulls are selling and the market goes down. The bears are always selling. The bears know that when they create this bar, they've trapped these buy the close bulls, and these bulls are probably going to try to get out break even when the market gets back to that close. These bears will sell more with a limit order at that close or a tick below that close, knowing that the bulls are going to sell there as well. So you get a give up situation. Somebody might look at this and say, this is just noise. It's not noise. It's happening for a reason. And that's true with every bar on the chart. Bulls giving up, so traders start to sell. They're expecting the bulls to give up here, so they sell closes. They sell above bars. Here's a bull reversal. They see 3 big bear bars closing below their midpoints. They believe the bull reversal is going to fail and become a bear flag, so they sell the bull close. We have a bear close here after the bull close. They sell the bear close. They sell below the bear bar. None of this is noise. It's all happening for a reason. Every bar is happening for a reason. Every now and then, someone asks me if the markets are different now from 30 years ago. And my thought about this is that all price action is genetically based. It's a reflection of rational human behavior, and that is due to our genes. And because that's the case, markets behave today the way they did 100 years ago, 1,000 years ago, and they will continue to behave the same way until we evolve into some kind of new species. For example, look at this chart. It goes back to the 1920s. Here's the 1929 crash. If I did not have these dates on here, you would look at that chart and say, oh yeah, it could be anything. It could be the euro versus the dollar. It could be the stock market. It could be Apple. It could be crude oil. It looks like charts that we look at every day. But yet it's not. It's from 80 years ago. Stock market crash, big sell-off. And when it bounced 50%, traders sold. 50% pullback. It sold off into a wedge bottom, spike and channel wedge bottom. And then it rallied to around 50% of that bear leg, and it tested this lower high. So now we have a breakout test of this low and a double top bear flag with this high, and we sold off again. World War II, we have 2 legs down, 1 pullback 2, and a higher low major trend reversal. Bear trend, bull breakout, and then a double bottom higher low. Traders buy. We got a pretty strong reversal up here, a pause. Traders expect a measured move up, and we get that. And that's also about a 50% retracement of that entire rally. We're looking at charts from decades ago, yet they're behaving the same as charts today. And that's because the market behavior is based upon human behavior and rational behavior. Traders behave rationally, just as they did back then. And if you have enough traders participating, all behaving rationally and in their best interest, this is the outcome. A chart that makes sense, and it looks the same today as it did back then. Doesn't matter if it's the Great Depression, World War II. Long before there were computer algorithms and high-frequency trading, charts looked the same. All markets and all time frames have the same price action. Here are 3 different charts. They all look very similar. One is a 5-minute chart, one's a daily chart, and one is a 1-minute chart, yet they all look the same. Price action is the same on all time frames. Now, which of these charts is General Electric, the stock, E-mini, and which is the euro versus the dollar forex market? Which is the daily chart? Which is the 1-minute chart? Which is the 5-minute chart? It's impossible to know because price action is the same for all markets. Doesn't matter if it's GE or forex market, and the same for all time frames. It doesn't matter if it's a 1-minute chart or a daily chart. And here's the answer, in case you're curious. Sometimes you'll hear traders on television talk about the pain trade. Beginners hate the pain trade. The pain trade is simply a low probability event. When traders see a bull swing like this, a series of bull bars, 6 consecutive bull bars, they assume this is a bull flag and that we're going to continue higher. The probability is that we're either going to go sideways or more up. The probability is that we're not going to go down, at least not anytime soon. So if something is obviously unlikely, like a bear reversal, it is more likely than what it appears to be. And that's my general rule. When something is extremely obvious, like this is extremely obvious we're going up, then it's probably not as likely as it appears to be. Whenever something is very unlikely, traders assume it's not going to happen, and they're positioned to the opposite. Here, a bear reversal is unlikely, so traders are buying pullbacks, they're buying breakouts, and bears are not willing to sell. But then something happens like this, and beginners are shocked. We had a bull breakout, and for an instant, this was a big bull trend bar, and then by the time it closed below its middle, it closed below the low of the past 7 or 8 bars. Despite the tail, it's a big bear reversal, closing below the low of 7 or 8 bars. The odds are we're going down. Bulls were heavily committed to their longs, thinking that the market had to go higher, thinking that the chance of a bear breakout was small. Now, all the bulls who bought anywhere in here, when this bar closes, they're all holding losing positions. They have to get out. The bulls have to sell. And the bears who wanted to sell higher and did not sell up here now are thinking, gosh, I got to sell lower. This is going down. Because a lot of traders are trapped into longs thinking the market should go up, they're often in denial when they see this bar. They see this big tail and say, well, maybe that's the end of the selling. Maybe we'll bounce back up. And if I bought over here, I'll get out break even on the bounce. It happens quickly, and traders don't adjust mentally fast enough, so they get trapped into a bad trade, coming up with reasons why the market will probably bounce and let them out without a loss. And they end up missing a good short. Professional traders, they get trapped into trades all the time, but they don't get upset. A professional trader sometimes will buy high, and they're not upset by the reversal down. If they believe the market's in a trading range, they'll simply buy more, trusting that it'll come back to their original price, and they'll make money on their lower entry and get out break even on their first entry. So they scale in. They know that 20% of the time a breakout will succeed and they'll lose. But because they know that 80% of breakouts fail, they can bet that breakouts will fail. They can buy high and then add on if it goes low, betting that the bear breakout will fail. They can sell high, betting that if it goes higher, it'll eventually turn down. So they'll sell more higher, betting that it's going to reverse, because they know that 80% of breakouts fail. Rally, reverse down, new low, reversed up, new high, reverse down, new low, reversed up. Eventually, the market will have a successful breakout, and they'll lose money, or they might lose money. If they're fast in understanding the price action, usually the breakout will give a clue before the breakout actually takes place, and then the fader will not take the fade on that final entry. Every pain trade is a breakout. This is a pain trade. A big breakout happens very fast, and beginners just get shocked. They are buying a series of bull bars. They see a bull flag, 2 little pushes down, 1, 2, they buy. They see a big bull close, a bull breakout, they buy. And then as this is forming, they're shocked. They can't believe it's happening. They keep hoping that it's going to stop here. It's going to stop here. It's going to stop here. They keep relying on hope instead of objectivity, looking at this saying, we're going down. I got to get out. And a lot of times beginners will think it's a conspiracy. It's not fair. The institutions are conspiring with one another to steal my money. You don't have enough money for the institutions to care. All of us individual traders put together do not have enough money for the institutions to care. We are 5% of the market. The institutions are 95% of the market. That 95% cannot make enough profit off the 5%, so they don't care about us. Professional traders, they love these breakouts. Beginners get trapped and complain that life is not fair. Professional traders understand what's going on, and they see this and they say, oh, it's going down, I'm going to sell. When it's doing this, there's a very high probability that it's going to go lower. So they don't get emotional, they just sell for any reason. They sell as the bar is forming, they sell this close, they sell above this bar, betting the bull reversal will fail. They'll sell below this bar, betting that we're going lower. They're just very quick to make the decisions. They don't get emotional. They know the market's going down, so they just sell. We got a lot of small bars, sideways bars. We go down, we go up, we go down, we go up. We're in a trading range. Traders know that 80% of breakouts will fail, and that it's better to sell high above bars, sell above this bar, sell above these bars, and buy low, buy below that bar, buy below this bar, buy below that bar, betting that when the bars look like this and we're sideways, it's a trading range, and most breakouts will fail. If it tries to break out to the upside, it's going to fail, so look to sell. If it tries to break out the downside, you have to assume it's going to fail as well. But professional traders are also aware that sometimes you get an unexpected big breakout. Sometimes news happens, sometimes fundamentals suddenly change, and the market can change dramatically. Like here. Here, with this bar, a big bull bar closing above its midpoint, closing above the high of the past 20 bars, traders decide that the price is wrong. And it's quickly moving up to a more appropriate price. Beginners get paralyzed because they're hypnotized into believing that this is going to continue forever. Experts immediately react, the market's different. The market believes this price is wrong, it's going higher. So experts buy. Here's a trading range. We have a bull breakout above the top of the range. And then we have a follow-through bar with a bull body. Traders believe the breakout has been confirmed and that the price is going higher, and that it probably will not reverse back into the range. A bear breakout. We have a bull channel and then a bear breakout. Not a particularly big bear breakout, but after you get 3 or 4 bear bars closing on their lows, the odds are we're going lower. And there's not going to be a reversal back up here to allow these bulls to get out without a loss. And then here we're accelerating to the downside, and we're probably not going to reverse back up into this attempt at a trading range. Now, how can a market break out if there's no news yet? Let's say there's no news here and the market starts to break out. Let's say here we're in a bull channel and we're starting to break out to the downside and there's no news. Markets often break out before news comes because buyers and sellers begin to sense that something is wrong, that the price is wrong. Maybe the price is too high. Maybe I should start selling some. Maybe the price is too low. Maybe we're going up. Maybe the trading range top needs to be higher to attract sellers. Maybe the trading range low is not low enough to attract buyers. Price leads fundamentals. So a lot of times, before the news comes out, the market will start to move. I remember years ago when Ronald Reagan ordered the bombing of Gaddafi's compound in Libya. I was running radio ads for eye surgery because I owned a eye surgery center back in the 1980s. And I noticed that crude oil was starting to go up, but there was no news. And then all of a sudden, we hear about the bombing of Libya, and crude oil soared on the bombing. Everyone started listening to the radio, and all of a sudden, my radio commercial buy resulted in a huge increase in the number of patients. I made a lot of money off Reagan bombing Gaddafi. I don't know how much I made, but probably $20,000 or $30,000 from that. The point of the story, besides the entertaining aspect of it, is that crude oil started to go up before Reagan bombed. Yet Supposedly, nobody knew in advance that he was going to bomb Libya. Here we have a fairly tight trading range. Bulls do not want to buy high. Bears do not want to sell low. So if it's low, it has to go up. If it's high, it has to go down. But sometimes what happens is bulls start buying at the top of the range, and they buy more as it's going up. And eventually, at some point, here and here, the bears start giving up. The bears start to sense that maybe the top of the range is not going to hold. Maybe this price is too low, and we have to reprice the market pretty quickly to find a more appropriate price. So bears stop selling at the top of the range and wait to sell much higher. And bulls, instead of selling at the top of the range, they buy. And when they start seeing this, they buy aggressively, knowing that price is too low. Bears are not selling. We're probably going higher. I'm always looking for a change in behavior. The market is behaving like a trading range here. And then here, I'm starting to pay attention. A bull bar closing on its high, a gap close of this bar above the high of that bar, and then a bigger bull bar closing on its high, opening on its low. So there's urgency, and it closed above the high of the past 10 bars or so. And this bar is bigger than that bar. If you're quick to notice these things, and you were selling highs, you stop doing that here, and you start thinking about, maybe I should just buy the close. Bears are not selling, so we're probably going up. A lot of times, 15 minutes later, there'll be a news report, and you'll look at the news and say, oh, that's why it went up. A lot of times, the reason for the breakout is not clear at the time the breakout happens, and the news happens immediately after the breakout. Did the news cause the breakout? Was there some kind of insider trading? I don't think that's the case, but a lot of times the market will start to go up minutes before a news report is released because traders sense that the market is going to go up or down. Now, the pain trade, it's a breakout, and it's a breakout of any support or resistance, like a trading range or a trend line, or a bull or bear breakout of a bear flag, or a bull or bear breakout of a bull flag. Bear channel, so it's a bull flag. Probability is we're going to get a bull breakout. It's also a wedge bottom, 1, 2, 3, or 1, 2, 3. A wedge bottom, 2 legs sideways to up is likely. But what would be the pain trade? We have a wedge bottom. Traders assume bear channel bull flag, we're going up. So if it's more likely we go up, the pain trade is if we go down instead. Anytime something is obvious, like, oh, we're obviously going up, always think that maybe the opposite will happen. Since a bear breakout is unlikely, traders are expecting either a trading range or a bounce. If they get the bear breakout, then the bulls who are buying, expecting the bounce up to these lower highs, are trapped in, and they have to exit quickly. And the bears are trapped out. The bears want to sell up here at these lower highs. They're not expecting it to go down. They see the wedge. They expect 2 legs up. So both bulls and bears are expecting the market to go up. But instead we get this. A bear bar closing on its low. Second, third bear bar closing on its low. A gap between this high and that low. We're getting a bear breakout below a wedge bottom. That should not be happening, a low probability event. So it's a pain trade, and it probably will last more bars than what traders believe will happen. On every chart, any time frame, 90% of the bars are within trading ranges, like here and here. Only 10% of the bars on any chart are in a breakout like this. During the breakout, traders believe the price is too high, and the market has to get down to some new level. Nobody knows exactly where it will be, but price is moving quickly to find a new range of fair prices. These breakouts only occur during about 10% of the bars on any chart. Markets are always constantly transitioning from trading ranges into breakouts, from breakouts into trading ranges. In this video, I talked more about what price action is, and I also talked about the pain trade. The pain trade is any breakout that appeared unlikely at the time that it occurred, and it traps bulls and bears in. If you have a pain trade that goes up, you have bulls who are trapped out and they have to buy, and they end up buying higher. You have bears who are trapped in to a bad short, and they have to buy to get out of their shorts. And the opposite is true if there's a bear breakout. This is Al Brooks. Thank you for watching the Brooks Trading course. This is one of the series of videos on chart basics and price action.